In this screencast, we continue our discussion of Bob's Instant Coffee Cart Case, Part 3. We'll look at sales, the accounting for accounts receivable, the allowance for doubtful accounts, and the recognition of bad debt expense. Before we get started, we'll take a quick look at the balance sheet as we left it at the end of the last screencast. The first transaction we want to look at is the collection of $340 of accounts receivable from the prior month and a write-off of $100 in those receivables. Remember, a write-off occurs when an account is determined to become uncollectible. The journal entries are shown, but we're going to take a somewhat closer look. So first, let's look at the collection of the accounts receivable. A debit to cash, because that's what was collected. And of course, once the accounts have been paid, there's a reduction in the accounts receivable. Notice the credit to the accounts receivable T account of $340. Now, when a bad debt is written off, we have a debit to the allowance to doubtful accounts, so notice the debit here, and a credit to accounts receivable. When the allowance method is used, there's no expense recognized at the time of a write-off. Rather, the expense is recognized as an accrual. Let's look at the presentation of accounts receivable on the balance sheet. Before we started these transactions, there was a net balance of $360, but after we collected last month's accounts receivable and wrote off $100 as uncollectible, notice now the net amount is only $20, $40 debit offset by a $20 credit. So the balance sheet after shows a net accounts receivable of $20. Additional sales were made during the month of May. Total sales of $6,200, $5,580 in cash, and $620 in accounts receivable. Notice, of course, that the net account receivable is increased from $20 on the last slide to $640 on this slide. I will assume that everyone is comfortable with how to account for the cash and how to account for the sales revenue at this point. Wages and wages payable we've seen before. We notice here that there are two journal entries. One for the payment of wages payable. In other words, we've paid wages that were accrued last month. And then, of course, there's the wage expense for the current month. This journal entry says that wages of $1,600 were earned this period, $1,100 were paid in cash, and at the end of the month, $500 remained to be paid. We can, of course, look at the impact on the balance sheet of these transactions, and as you can see, the before and after, and hopefully you should be able to trace these journal entries to the change in the before and after balance sheet. The allowance for doubtful account and bad debt expense is another transaction worth taking a second look at. Currently, the allowance for doubtful accounts has a balance of $20 in it. However, the policy for BICC is to recognize 25% of the gross receivables at the end of the month as allowance for doubtful account. So what that means is that BICC has to go from a credit of $20 in the allowance to doubtful account to a credit of $165 in the allowance for doubtful accounts after adjustment. $165 being the 25% of $660. So what remains then is how do we go from this credit balance of $20 to a credit balance of $165. And this amount, it will be the bad debt expense for the period. Well, it's not too hard to determine that the credit that's required is $145, and we recognize the bad debt expense as $145 and credit the allowance of doubtful accounts, $145. And of course, on the balance sheet, we'll see accounts receivable presented as gross accounts receivable of $660, a credit of $165 in the allowance for doubtful accounts, and therefore a net account receivable of $495. Cost of goods sold is another transaction we've seen before. Before a cost of goods sold are recognized, we look at the inventory T account, beginning balance of $525, purchases of $3,600, meaning the current balance is $4,125. A count of the inventory at the end of the period indicates a balance of $450, so to go from the T account before to the T account after requires a credit of $3,675. This is accomplished by a debit to cost of goods sold for $3,675 and a credit to the inventory account for $3,675. And once again, we show you the balance sheet after the journal entry has been taken into account. This completes the second of 3 videos for BICC case part 3. Once again, we leave you with a few variations that you should try just to make sure you fully understood the material presented in this videocast.